You're holding shares in a company whose only real job is buying Bitcoin. Your position just lost 70% of its value, while Bitcoin itself went up 14%. That's not a typo, same asset, opposite direction, and the gap is widening every day. The explanation lives in a single number called mNAV, multiple to net asset value. And right now, for the biggest player in this game, it sits at 0.68. That means the market values the entire company at 68 cents for every dollar of Bitcoin it actually owns. A year and a half ago, that same ratio was 3.4. The company traded at more than 3 times the value of its treasury. Same coins, same wallets, same executive team. The only thing that changed was the arithmetic underneath the trade. And when mNAV crosses below 1.0, the whole machine starts running backwards at exactly the speed it used to run forwards. You clicked because infinite money glitches don't just stop, they invert. Here's what makes this particularly brutal. The company has issued over $7 billion in stock this year alone, every share sold below NAV making the problem worse. And they can't stop, because stopping means admitting the model is broken. The shareholders who bought at 3 times premium are now underwater by margins that would make a housing crisis blush. The converts are ticking. The copycats are drowning. And the mechanism that once minted billionaires is now incinerating capital with the same mechanical precision. Go back to 2020. If you want Bitcoin exposure, you've got 3 realistic paths. Set up a wallet and navigate seed phrases, trust an exchange that might blow up, or buy shares in Grayscale's trust which trades at wild premiums because it's the only game in a brokerage account. That scarcity had value, not the coins but access to coins inside a vehicle your Fidelity login recognized. A company called MicroStrategy saw that gap and built a different trade. They'd issue new shares at whatever price the market offered, use the cash to buy Bitcoin, and because they paid less per coin than the market valued the shares, every purchase raised the Bitcoin per share ratio for existing holders. If you owned 1 share representing 0.001 Bitcoin before the deal, you owned 0.0011 after. Same share count, more coins underneath. The premium was the fuel. As long as the stock traded above net asset value, above 1 times mNAV, the loop was accretive. Investors paid up because spot ETFs didn't exist, and this was a leveraged bet in a wrapper institutions could hold. The company added debt on top, further goosing returns when Bitcoin rallied. Bitcoin up, stock up more, issue more stock, buy more Bitcoin, repeat. For a while the ratio hit 3.4. Every dollar of Bitcoin the company held got valued at 340 by the market, which meant every new share issued was buying coins at a 70% discount to what shareholders were implicitly paying. The operational business became irrelevant noise, contributing maybe 3% of enterprise value. The other 97% was the treasury and the premium on the treasury. It felt like magic because the math made it magic, a perfectly legal arbitrage between what institutions could buy directly and what they'd pay for indirect exposure. January 2024, the SEC approves spot Bitcoin ETFs. Now your brokerage account can buy IBIT or FBTC with the same 2 clicks as any stock. 0 premium, 0 lockup, net asset value every single day. The entire reason to pay 3 times for indirect exposure vanishes overnight. You'd expect the premium to compress. It does, but not instantly, because momentum, and because there's still a narrative that this isn't just a wrapper. It's a leveraged volatile proxy with a $1 trillion balance sheet dream attached. The market gives it 6 months, then the copycats arrive. By mid-2025, there are over 200 publicly traded companies calling themselves Bitcoin treasury plays. Some hold a handful of coins and a press release. Others are penny stocks that pivoted from blockchain dog food or whatever. Supply floods the market. The premium that was scarce is now everywhere, which means it's nowhere. Investors who want Bitcoin leverage can just buy Bitcoin and use actual leverage, or buy a 2x ETF that launched shortly after. The structural moat collapses. By November 2024, the mNAV is still above 3 but falling. By March 2025, it's 1.8. By June, it's 1.2. And here's the part that gets me: the company keeps issuing. They have to. The entire equity story is denominated in Bitcoin per share growth, and if they stop buying, the narrative dies. So they issue stock at 1.1 times, then at 1.05, then at 0.98. That last one is the threshold. Below 1, the arithmetic reverses. The chairman goes on podcasts explaining this is a long-term strategy, that the premium will return. None of it stops the slide because the premium was never about conviction, it was about having no other choice. Let's make this concrete with real scale. You're the company. You hold 170,000 Bitcoin, acquired at an average price of around $49,000 per coin. You have 200 million shares outstanding. That's 0.00085 Bitcoin per share. Your stock trades at $220 and Bitcoin is at 73,000. So your net asset value per share is roughly $620. Your mNAV is about 0.35. Catastrophic. Now you want to do another raise because the playbook says accumulate. You issue 20 million new shares at 220, bringing in $4.4 billion. Bitcoin's still 73,000, so you buy 60,274 Bitcoin. Your new treasury is 230,000 coins. Your new share count is 220 million. Bitcoin per share is now 0.00081. You started at 0.00085. You just spent $4 billion buying Bitcoin, and your existing shareholders now own less Bitcoin per share than before you started. The dilution is mechanical. If you're issuing equity at 0.35 times NAV, you're selling $1 of claim for 35 cents, and using those 35 cents to buy $1 of the asset, netting existing holders a 65-cent loss per new dollar of equity created. The company issued over $27 billion in equity and converts during 2024 and 2025, most of it above 1 times NAV when the loop still worked. But every deal done below 1 times, and there were 11 of them between April and October 2026, was reverse compounding the shareholder position. The same action that once built generational wealth now destroyed it at industrial scale. Equity wasn't the only lever. The company issued convertible bonds, debt that turns into stock if the price goes high enough, and pays almost no interest in the meantime. When mNAV was 3, converts were a genius move. You'd borrow at 0.5% interest, use the cash to buy Bitcoin, and if the stock ripped, the bonds converted at a preset price already below market, so conversion was another accretive equity issue at a discount. You got leverage, Bitcoin, and future equity issuance baked in at favorable terms. Free money twice. When mNAV is below 1, those same converts become a trap with teeth. If Bitcoin falls, the debt stays debt, and you owe par at maturity real cash, not stock. If Bitcoin rises enough, the converts turn into shares, issuing new equity exactly when you least want dilution, because now you're below NAV, and every converted dollar dilutes per share Bitcoin. The company has around $7 billion in converts outstanding as of mid-2026, with tranches maturing in 2027, 2028, and beyond. All were issued when the stock traded at a premium, some as high as 2.5 times. Now the stock is at a 32% discount, and the bonds are senior claims accruing value while equity bleeds. If Bitcoin doesn't recover past certain conversion strikes, the company faces a wall of maturities it has to roll or repay in cash. And rolling means issuing new debt into a market that now prices in unwinding risk and demands real yields. The conversion optionality that was a gift is now dilution you can't control. It triggers automatically if Bitcoin moves, flooding the share count exactly when you're trying to defend per share metrics. You can't stop issuing because debt service requires liquidity, and the equity story requires Bitcoin per share growth. But every new issue under 1 times mNAV makes the per share situation worse, which pushes mNAV lower, which makes the next issue even more dilutive. So who's still in? Early investors who bought at mNAV of 1.2 in early 2025 are down 62% even though Bitcoin is up 11% over the same period. Retail holders who thought they were getting leveraged upside are getting leveraged downside with no dividends, no buybacks, nothing to soften the fall. Institutional money that piled in during the 2024 run is stuck selling a $9 billion position into a stock that trades $40 million a day would take months and crater the exit price. Some funds are in because they have mandates around equities and can't hold spot ETFs due to category restrictions. Some are indexed and just eating the pain. The thesis for holding at 0.68 mNAV is that Bitcoin goes up enough and fast enough that the NAV rises faster than the dilution. mNAV mean reverts above 1, and the flywheel re-engages. That's not insane. It's happened before on smaller drawdowns in 2022, when mNAV dipped to 1.4 and recovered. But it requires Bitcoin to move and the premium to come back, and the premium was never about Bitcoin's price, it was about scarcity of access. That scarcity is gone. 200 competitors, 10 spot ETFs, leverage products everywhere. The only reason mNAV would sustainably recross 1 is if the market decides this particular company's treasury strategy has some operational alpha that justifies paying more than net asset value for a pile of coins. There's no evidence of that, The company doesn't mine, doesn't stake, doesn't lend the coins. It buys spot and holds in cold storage. A spot ETF does that for 7 basis points a year with daily liquidity at NAV. This equity charges nothing explicit, but dilutes continuously, which is a hidden fee now running north of 15% annualized at current issuance rates. The rational holder at 0.68 is either trapped by position size, betting on convert hedging flows, or convinced Bitcoin's about to go parabolic enough to overcome the structural headwind. You can't just admit the playbook is cooked, so you diversify the narrative. By late 2025, the company starts talking about Bitcoin-backed services, institutional custody solutions, Lightning infrastructure, Layer 2 protocol investments. The CFO mentions software revenue could reach $100 million annually within 3 years. None of it moves the needle. $100 million in software revenue against a $70 billion market cap is a rounding error. And the services businesses have entrenched competitors like Coinbase and Fidelity Digital, who have been doing custody for years with regulatory moats this company doesn't have. The market doesn't buy it because those businesses operate at 10 to 15% net margins, and this company's entire valuation is predicated on Bitcoin exposure, not software multiples. The core asset is still the coin pile, and the core liability is the discount to that pile. Another move, slower issuance pace, more selective raises, waiting for better windows when mNAV ticks up on Bitcoin volatility. That helps at the margin, but doesn't solve the structural problem. If you're at 0.68 mNAV and you stop issuing entirely, Bitcoin per share stays flat, and you're just a closed-end fund trading at a 32% discount forever. If you keep issuing below 1, you're actively destroying per share value. The only real fix is getting mNAV back above 1. And the only paths there are Bitcoin moons hard enough to outrun the dilution, or the market suddenly decides to pay a premium again for no new structural reason. Some activist shareholders push for a share buyback program. If the stock is trading at a discount, buy back stock instead of issuing it, retire shares, tighten the structure. The company resists because buybacks mean selling Bitcoin to fund the repurchase, which breaks the prime directive of never selling. It's a narrative trap. The identity of the company is accumulation, and pivoting to value return admits the accumulation phase is over. Neither path is clean. Let's game out the worst case with actual balance sheet numbers. Bitcoin has another extended bear cycle, drops to 48,000 and sits there for 18 months. The company's NAV per share falls to around $400. The stock, trading at 0.4 times NAV now, sits at 160. The converts come due, $3.2 billion worth, maturing in 2027 alone. The company can't roll the debt without offering 8% yields because the market now prices in structural risk. And 8% on $3 billion is $240 million a year in cash interest they don't have because they don't generate free cash flow. They're forced to sell Bitcoin to meet maturities or take on even more punitive financing. Every coin sold reduces the treasury, which reduces the NAV, which pushes mNAV even lower. Equity holders get wiped to near zero because the discount becomes self-fulfilling. If the market believes the company will be forced to liquidate over time, no one pays anything close to NAV for the shares. You just wait for the liquidation and buy Bitcoin spot 30% cheaper. The company still exists, still has coins, but the equity becomes a terminal discount vehicle with no recovery path because the debt stack keeps requiring asset sales and every sale makes the equity worth less. Converts get par or converted shares, senior debt gets paid, equity gets pennies on the dollar. That's the nightmare, and it's not the base case because Bitcoin would have to stay down and funding markets would have to freeze, but it's possible, and the fat tail risk is why mNAV is where it is. The market is pricing in some non-zero probability of forced unwind or death spiral dilution. The opposite scenario, Bitcoin rips to 120,000 in 6 months, the NAV per share doubles, the stock goes up 4x because of embedded leverage, mNAV gets back to 1.2, and the flywheel catches again. Possible, and that's why anyone's still holding. But now you're just making a directional Bitcoin bet with extra steps, structural risk, and a debt maturity schedule that doesn't care about your thesis. Here's what stays with me. Nobody had to be wrong for this to invert. The executives believed, the investors believed, the model was mathematically sound, and it worked flawlessly for 4 years straight. It just depended on a premium that was always fragile because it was never about the company. It was about the absence of alternatives in a specific market structure that no longer exists. The moment spot ETFs launched, the clock started ticking. The moment 200 copycats launched, the premium fragmented into noise. The moment mNAV fell below 1, the flywheel reversed polarity with no fanfare, no drama, just arithmetic. Same spreadsheet, same custodied coins in the same cold wallets, opposite outcome. Issuing equity to buy Bitcoin used to compound your per-share position at rates that made early shareholders generationally wealthy. One guy who bought in 2020 and held through 2023 turned 40,000 into 11 million. Now it dilutes your position at the same mechanical rate. The speed of destruction is proportional to the speed of issuance, which means the faster they ran the glitch, the faster it now runs backward. There's a bigger lesson here about what happens when a financial structure is built entirely on a relative scarcity that can evaporate overnight through regulatory change or market evolution. The coins are still there, 230,000 of them, worth $17 billion at current prices. The company is still operating, still hosting earnings calls. But the machine that turned market enthusiasm into per-share wealth is now a machine that turns continued issuance into per-share decay. And it will keep running until either the premium comes back or the equity goes to zero or the debt forces a restructuring. The ratio is everything. It was always everything. And once it flips, the infinite money glitch doesn't stop working. It works exactly as designed in reverse, compounding loss with the same elegant efficiency it once compounded gain. Every share issued a precise calculable transfer of value from existing holders to new buyers who are getting the coins cheaper than the market previously implied they were worth.